Hello class, the purpose of this presentation is to clear some of the issues asked by the students in answering the activities related to the computation of the corporate income tax. Basically, the corporations subject to income tax are the following: the domestic corporation, the resident foreign corporation, and the non-resident foreign corporation. A domestic corporation is a business entity that is organized, registered, and existing under the Philippine laws. And the resident foreign corporation is a foreign corporate entity being brought to the Philippines and secured a license to do business in the Philippines through the Securities and Exchange Commission in the Philippines. A non-resident foreign corporation is one which does not have any presence in the Philippines but derives income in the Philippines, uh, such as interest income from the extension of foreign loans and dividend incomes from the investment in the shares of stock in the domestic corporation in the Philippines. The common taxes imposed to corporations are normal income tax. Other practitioners call this NCIT or normal corporate income tax, or regular corporate income tax or RCIT of 30%. The minimum corporate income tax or MCIT of 2%, the capital gains tax 6% and 15%, the final tax on passive income, and the improper accumulation of earnings tax of 10%. We will discuss these items on the following slides. Let us assume this is a domestic corporation with income subject to normal income tax or regular corporate income tax. Take note that the corporation applied the itemized deduction. So the itemized deduction is an expenditure on eligible products, services, or contributions that can be subtracted from gross income. Example of these are salaries expense, rent expense, supplies, repairs and maintenance, professional fees, and other ordinary and necessary expenses. So, since the company is subject to normal income tax or regular corporate income tax, after deducting the total expenses from the gross income, you will get taxable income of 1,300,000 and just multiply this to 30% and you will get 390,000. In the case the corporation opted to use the optional standard deduction, there is no need to compute for the itemized expenses. You just simply deduct the 40% of the gross income from the gross income. In this case, you will get 800,000. So that is 2 million times 40%, you will get 800,000. So deducting 800,000 from 2 million, you'll get taxable income of 1,200,000. And you'll get 360,000, which is 30% of 1,200,000. Take note that the optional standard deduction in case of individual, the 40% is multiplied directly from the gross sales or gross receipts, not the gross income. So unlike the corporation, the 40% is being multiplied in the gross income. Okay, take note of that. In comparing the itemized and OSD, it's pretty much obvious that OSD is easy to compute. And obviously, you will get a different result in computing the income tax due. In this case, the income tax due for optional standard deduction is lower than the income tax due in using itemized deduction. This is not always the case, wherein the optional standard deduction is always lower than the itemized deduction. It will depend on the items included in the itemized deduction or the total expenses of the itemized deduction. So if the total expenses is greater than the amount derived from the optional standard deduction. So definitely the income tax due under the itemized deduction will be lower than the income tax due uh, computed from the optional standard deduction. On the fourth taxable year of the company, the corporation is now required to pay MCIT if the MCIT is greater than the NIT or RCIT. So MCIT is the minimum corporate income tax of 2% of the gross income. In this example, we have a gross profit or gross income of 2 million multiplied by 2%, that is equal to 40,000. So in case of the taxable due or tax due, the amount is 30,000. Obviously, the MSIT is greater than the RSIT or normal income tax. So, ang tax payable mo dito ay 40,000. So, meron kang excess of MCIT of 10,000. So, ang babayaran mo ay 40,000. So, lumilitaw dito para kang nagpapahiram sa government ng 10,000. So, mababawi mo lang yung 10,000 na yan kapag ka next year, the following year, mas malaki na yung tax due mo over sa MCIT mo. So, pagka mas malaki na yung tax due mo, yung 30% mo, you will less the 10,000 on the following year. So, para yung excess ng MCIT mo ngayon is i-deduct mo. So, parang isosoli na ng government sa iyo yung 10,000. Pagka patuloy pa rin na mas malaki ang MCIT mo over yung sa regular income tax mo, palagi ka magbabayad ng tax mo using the MCIT. So, palagi ka magpapahiram sa government kung palaging mas malaki ang iyong MCIT over sa iyong RCIT. Ang problem lang is na expire ang iyong excess of MCIT over RCIT after ng 3 years. So, habang yan ay mas malaki yung binabayaran mo sa government, and then may possibility hindi mo na mabawi because nag-expire yung excess of MCIT after 3 years. In the case of corporation, here is a summary of income subject to tax. So, DC is a domestic corporation, RC is a resident corporation, and NRC is non-resident corporation. FT here is final tax. So, the case of sale of land and building held as capital asset, the basis of the 6% tax is on the selling price or the fair market value on the date of sale. Take note, whichever is higher. So on the gain on sale of shares of stock of domestic corporation not listed and traded in local stock exchange, the tax is 15% of the capital gain. Ayan, so in the case of resident corporation, it's 25% and non-resident corporation is 15%. Please remember the rate, especially the domestic corporation. On the interest on foreign currency deposit under expanded foreign currency deposit system, it's 7.5%. That is the interest income times 7.5%. That is final tax. Ano ba ibig sabihin ng final tax? So, kapag ka na-tax na yan, let's say 7.5%, hindi na yan isasama as part ng iyong income subject sa 30%. So, kaya final na siya. So, 7.5% yan. Kasi passive income yan. So, later, try natin mag-solve ng problem related to this type of taxes. No? Dividend from domestic corporation. So, if a corporation receive a dividend from a domestic corporation, the tax is exempt. So, walang tax. Exempt. And the resident corporation as well, is not subject to tax. It's also exempt, provided that the dividend is coming from domestic corporation. In the case of the non-resident corporation, the corporation is subject to final tax of 15%. In the interest on any currency bank deposit, ayan, it's subject to 20%. Example, you have a savings account in the corporation has a savings account in a local bank here in the Philippines, let's say Metro Bank. So, if nag-earn ng interest yung kanyang savings account, definitely it will be subject to 20% final tax. Again, the interest income from the bank is no longer subject to regular corporate income tax of 30% because it is already subject to final tax of 20%. So again, the normal tax on the taxable income within and outside the Philippines for domestic corporation is 30%. On the fourth taxable year, i-apply naman na yung MCIT. In the case of the resident corporation, take note, lahat lang ng income within the Philippines. And it is also subject to MCIT on the fourth taxable year. In the case of the interest on foreign loans, ang non-resident corporation ay subject sa 20% final tax, and the taxable gross income within the Philippines is subject to final tax of 30%. Here is a sample problem for a domestic corporation. Let us assume the corporation has a gross sales of 20 million with a sales returns and allowances of 900,000, and then sales discounts of 1,500,000, and the cost of goods manufactured and sold 10,500,000 with a deductions of 4 million. Let us assume itemized deduction ito, no, yung 4 million na to. And it has interest income from international bank under the FCDU or FCD system, and the interest on notes receivable, dividends from Yosuke Corporation, a resident foreign corporation, a capital gain on sale of Beauty Corporation shares, a domestic corporation to a direct buyer. So, ibig sabihin not listed ito, not traded in the local stock exchange. And dividends from Blink Corporation. It is a domestic corporation. So, ang requirement muna natin dito is to determine the items to be included in computing the regular corporate income tax or the final tax. So, nilagay ko na yung sagot dito sa bandang kanan. So, gross sales definitely will be included in the computation of the regular corporate income tax, the sales returns, the sales discount, the cost of goods manufactured, of course, i-deduct nyo lahat yan, and the deductions or the itemized deductions. In the case of the interest income from the international bank, it is subject to final tax of 7.5%. In the case of the interest income on notes receivable, it is not subject to final tax, but it is subject to regular corporate income tax. How about the dividends from Yosuke Corporation? It is a resident foreign corporation. So, kung babalik ka dun sa kaninang slides, pwede mong i-pause ito. And then, balik ka dun, makikita mo, yung dividends from a domestic corporation is exempt from income tax. But since this is a dividends from a resident foreign corporation, it would be subject to regular corporate income tax. So, the capital gain on sale of Beauty Corporation, a domestic corporation to a direct buyer. So, this is not a dividend but a sale of shares of stock. So, the capital gain on the sale is subject to final tax of 15%. Dividend incomes from dividends from Blink Corporation, a domestic corporation. Ito, subject yan sa actually exempt siya. Ayan. So based on the information from the previous slides, the income tax due under the RSIT is 1,017,000. So as you notice, we use the gross sales, the sales returns and sales discounts were deducted from the gross sales to get the net sales. And then the cost of sales or cost of goods manufactured and sold uh, amounting to 10,500,000 was also deducted from the net sales to get the gross profit of 7,100,000. And then the interest on notes receivable, since it is also subject to RSIT, and the dividend income from a foreign corporation, we add the amount of 290,000 to the gross profit to get the total gross income of 7,390,000. And then we deduct the deduction, the 4 million, the itemized deduction. So get the taxable income of 3,390,000. And there you go, you will get 1,017,000, which is equivalent to 30%. That is your tax due. In the case of the interest income from international bank under the foreign currency deposit system, it is not subject to RCIT because it is subject already to final tax of 7.5%, which is 7,500 of 7.5% of 100,000. And the capital gain on sale of beauty corporation shares, a domestic corporation, to a direct buyer is 15% of 90,000, which is 13,500. So, as you notice, yung mga passive income are not subject to regular corporate income tax, but they are subject to final tax. So, mas maliit yung rate as compared to 30%, although yung regular corporate income tax is based on the taxable income, which is net of deductions. But sa case ninyo guys, dapat ito yung main goal ninyo, to have a passive income. Passive income is a source of income wherein you are not actively participating on the business. So you just derive your income from the interest, the capital gains, from dividends, and yet the tax rate is pretty much lower than the regular corporate income tax. I know guys, familiar na kayo sa equity portion ng balance sheet of a corporation. Remember, the asset is equal to liabilities plus equity. The equity portion of the corporation is called stockholders' equity. So basically, it includes the capital stock and the retained earnings. Yan. So capital stocks is the investment of the stockholders, and the retained earnings is the accumulated earnings of the company or a corporation. So remember the net income. So the net income pumapasok sa retained earnings. So magiging part ng retained earnings ang net income mo, and then next year ulit kapag kumita ulit, papasok ulit yan as part ng net income. So na-accumulate yung income habang yan ay hindi dinidistribute sa mga stockholders in the form of dividends. So kapag kumikita ang company, syempre masaya din si stockholder, especially si Juan na isang individual shareholder ng company. So pag naka-receive siya ng dividends, ayan, kukunin ng corporation sa 5 million yung dividends na yan. Let's say nag-declare siya ng 2 million cash dividend. So, babawasan niya yung 2 million dyan sa 5 million na yan. So, may matitira pang 3 million yung company. Yung 2 million mapupunta sa mga stockholders. So, masaya si Juan kung isa siya sa makaka-receive ng dividends out of the 2 million cash dividend. And of course, masaya rin si BIR, yung government. Why? Kasi makaka-receive ng 10% yung BIR doon sa dividends ni Juan. So, ibig sabihin kung si Juan ay makaka-receive ng 100,000, supposedly 100,000 ang marireceive niya. Since dividends yan, the corporation is required to withhold a portion of the 100,000, which is 10% of the 100,000. That is 10,000. So makaka-receive si Juan ng 90,000 and the government will receive 10,000. So masaya si Juan, masaya rin ng government. But in the case of corporation receiving the cash dividend from a domestic corporation, remember, exempt siya. But, ayun nga, si cash dividends, kapag ka dinistribute mo yan kay individual, makaka-receive yan ng net of 10% na final tax. Ayan. So, in the case of the example dito sa baba, no? So, meron kang 6 million retained earnings. If you will notice, lumalabas. Since lumagpas na siya dun sa capital stock na 5 million, yung retained earnings na 6 million. So, it seems meron siyang improper accumulation of profit. Kaya improper yan kasi yung mga stockholders, they have the right to receive dividends. Pero hindi ka nagde-declare ng dividends. Therefore, hindi masaya si Juan as a stockholder. So, ang gagawin ni government, since siya hindi rin masaya, so hindi siya pwedeng hindi masaya. So kahit si Juan hindi masaya, pero siya dapat siya masaya. So i-charge kanya ng 10% on the improper accumulation of profit, which is 1 million of the 6 million retained earnings. As you notice, kung equal yung retained earnings mo with your capital stock, hindi pa yan improper accumulation of profit. Under kasi sa tax code and corporation law, no? But in case yung retained earnings mo ay lumagpas na siya ng 100% sa capital stock, so yung excess na 1 million dito sa 5 million is already subject to 10% improperly accumulated earnings tax. So that's it for now. See you on the next video.